There are plenty of warning signs about the state of the economy. Stock and house prices are falling, interest rates are going up, and we all know the cost of living is sky high. And there are even reports out of America that the White House is preparing for $200 a barrel for oil in the near future. Just imagine what that does to the transport industry and the flow-on effects to your budget. But it's not just Australia that's facing these challenges. It's a global phenomenon. It's brought on by artificially low interest rates, governments printing money, and, may I say, excessive credit use. That is wreaking havoc through the bond markets and most other financial markets too. And what it means is that some countries won't be able to pay their debts, which means the lender ends up paying. You see, all debts are paid by either the borrower or the lender. And that means, again, if emerging markets countries do not cough up the cash they owe, the rich Western nations who lent them the money will have to. And I point this out, the global bond market dwarfs the stock market. And if it goes belly up, the pain will be felt far and wide. It's almost as if we've hit a tipping point, that part greatest financial crisis of 2008, maybe a bit of Asian financial crisis of 1997 and the Japanese stock market crash of 1991. It seems like a perfect storm. So what's in store? And more importantly, what does it mean for you? Here to share his insights is Managing Director of EQ Economics and former Chief Economist of ANZ Bank, Warren Hogan. Warren, thank you for joining me on Bernardi. How concerned should we be about the short-term future of the Australian economy?
Thanks for having me on, Cory. I don't think we should be overly concerned about an imminent disaster. But of course, the economic environment we now find ourselves in is probably the most challenging and dynamic we've seen for a generation, maybe going back as far as the 1980s. And what I mean by that is the underlying economy is actually doing very well, whether you look at the United States, Europe, or here in Australia. But there's a lot of inflation, as you note. Interest rates are going up, financial volatility is picking up, and of course we're seeing a lot of turnover in the economy. People are changing jobs because of labour shortages, and I suspect we're going to start to see the business failure rate pick up. So it's in the context of what is actually a pretty healthy backdrop to activity. But as you note, there's all these little warning signs that, of course, have everyone worried. But the primary challenge is this inflation and cost of living issue and how high interest rates have to go up to address that.
Yeah, it's a huge challenge. I mean, particularly to warn people about what has to happen. There may be some short-term pain in order to make long-term sustainable progress. But what should the government be doing now? It's a new government. I'm not going to blame them for what we've got, but they're going to wear the responsibility of how they deal with it. What should they be doing to make life easier for Australian investors and the general public?
Well, I think your point about a bit of short-term pain for long-term gain is spot on here. And it's something we haven't been particularly good at in a number of respects, particularly in relation to economic policy in the last couple of decades. I actually think there's a chance we'll have a mild recession both in the United States and Australia in the next 12 months, but it's the recession we want to have. It won't involve a big rise in unemployment. It won't involve a major dislocation of the financial system, and it'll be shallow and we'll recover it quickly, but it'll be a result of having interest rates taken back to a more normal level, and hopefully as part of it, we'll get inflation under the control. So what does the government have to do to execute on this? And this is what the Reserve Bank is now talking about, is we have to get rates up to a more normal level, probably, I think in the first instance, another 200 basis points or 2 percentage points of increases. And of course, the government in their October budget needs to plot a course for much smaller fiscal deficits, because that is adding to the problem, and indeed is probably the source of a lot of this inflation around the world, these big fiscal deficits funded by quantitative easing in most countries. So I think there is a pathway to getting back onto what I'd call an even keel over the next couple of years, but it is going to involve a slower economy next year.
Well, I tell you, some words you said then, I'm old enough to be alarmed by them. The recession we want to have, it's very similar to the recession we have to have, uttered by Paul Keating back in the early 90s when he was Treasurer. That was actually a disaster for people. They tried to engineer a brief recession, but it really created a massive problem. How can we avoid that sort of calamity happening? Because we can't exactly keep printing money and borrowing money to stimulate the economy perpetually, can we?
Yeah, no, it's a good point you make, and I would like to note that I call it the recession we want to have because it's all about avoiding a recession we had to have, i.e. the 1990s. In this country, the early 90s recession was a financial crisis. It was our equivalent of the GFC. We almost lost two of our major banks and the unemployment skyrocketed up to 11%. We do not want to see that ever again. Now, a mild recession, which is really technical in nature, with just a sort of mild slowdown in growth, maybe a couple of small declines in growth over 6 months. But the key is unemployment doesn't go up significantly. It might go up a little bit, and we recover quickly. Now, the RBA needs to move the interest rate quickly because it's completely out of whack with the economy and has been for some time now, as many central banks around the world are doing. But if they don't get that right, and if they don't get on with the job, and they allow the imbalances, the inflation pressure and the momentum in the economy to build over a number of years, we end up in a position where we may have to put the economy into recession like the early 1990s or like the US did in the early 1980s. In fact, many people out in the financial markets believe that the only way we're going to get out of this inflation problem in the United States and Europe is through a reasonably severe recession. Now, I don't think that the outlook's that pessimistic, but there is a mild recession potentially on the horizon that we shouldn't be overly afraid of and that we'll recover from quickly.
Okay, quick question, because someone asked me today, should Australians be fixing their interest rates on their mortgages? It's about 5.5% for 5-year money. It's 4.5% or 4.7% for 2-year money. Is that a good idea if you're expecting rates to go up?
Look, yeah, it's really where you think interest rates are going to go. The financial markets have them going up to 4 or what would be maybe a 6% mortgage rate. I think it won't get quite that far up in the next year or so, maybe in the next 3 or 4 years it will. I'm not sure now that all the fixed rates have moved a lot that there's a lot of value in fixing. The time to have fixed was 6 months ago when interest rates were at rock bottom. Unfortunately, back then the Reserve Bank governor was telling us he was going to keep the variable rate where it was for 3 years, which has proven to be wrong, but that was the time to fix. So most Australians ride variable mortgage rates, have done for the last 3 or 4 decades, and you need a pretty good reason to fix. And right now those fixed rates are very high. They've moved a long way, so I don't think it's a standout thing to do right now.
All right, Warren Hogan, thank you very much for your insights tonight. I look forward to speaking with you again on Bernardi very soon.